Hey everybody, this is Finding Value. I'm going to go through a lot of information in this video clip. I called it Understanding Cycles, but it's about the commodity cycle. I'm going to give you an example with one of what we look for bottoms in commodities and kind of the power of a bull market. I'm going to go over those traits there. I'm going to step into not just understanding the traits, but also what to look for in companies in commodities. Do you buy low-cost producers or do you buy high-cost producers? What's the difference between the two? And then I'll have a bonus section at the end after a conclusion that I do. So stick around to the end. It's going to go over probably peak energy and what copper looks like and kind of how commodities eventually are going to fall in terms of production. So let's jump in. You're going to lose me so you can see the whole clip, whole slide deck. So understanding cycles. So I've got a silver chart right here. And if you're new and you've never looked at commodities, you just say, I wish I could buy here and sell up there and buy here and sell up there. But why did it fall to this level down here? Why didn't this go all the way down to, $5 or $4? What's the reasoning? What are some reasoning behind these price movements? And that's what we're going to get into. So this is what interests, you should be interested as an investor for these things. This is what you should know about a commodity to really get the full cycle. You need to know what the cost of the producers are. This is the bottoming of the price. If the price goes below the higher cost producers, that's when supply starts getting cut back. If you know where the producer costs, the mid-tier and the higher cost producers lie, you're going to know roughly where the price will bottom, because that's where all that supply will get cut back. You need to know the time frame to bring on new production and the cost of new production. So that's the cost of the higher producers and how long does it take to bring on that new production. We've got the demand and supply projections for that's future, and the difference between the two. Is it a deficit or a surplus? How big are those deficit and surpluses in the future? And where are they occurring? Is it a growing deficit as time goes on, which means it's going to be a very large bull market? Or is it just small projected deficits or surpluses? If you're in a surplus situation, price is going to go down. If it's in a deficit situation, prices are going to go up. You're going to look on the demand side. Is the demand elastic? What's the elasticity of that demand? Inelastic, it's going to go a lot higher. If it's $1 higher and everybody doesn't want to buy, obviously the price isn't going to move very far. If it goes up 10 times, but your demand is still going to be robust, something like a nuclear power plant wanting uranium, then yeah, it's going to continue to go higher until new production comes online. So yeah, we want to look at demand elasticity, the balance, deficit, or surplus, especially in the future if it's growing, and I'll get into this later and show you what one looks like, and the time for production to come online. That's going to equal your bull bear market power. If you have an inelastic demand with a very large and growing deficit, with a very long time to bring on new production at high cost, you're going to have a massive bull market at some point. And just for your own information, retail money chases prices during an up cycle. So it's increasing demand during an up cycle, and then same goes for when it goes down. They all pile in at the end and they all pile out, losing a bunch of money. This is the silver demand, so I'm going to go over a silver. I know silver's pretty big with a lot of people. They like silver a lot. So I'm going to go over an example. So this is where your demand's coming from, and this is kind of some information. So as prices increase, industrial demand's usually pretty robust and it stays the same. Your silverware and jewelry will probably decline some, but a lot of retail people are going to chase. So this silver coins and bars is going to probably explode higher as prices increase. The prices increase in the beginning. We call it the smart money buys in the beginning. The institutional investors come in second, and then retail comes in last. That's kind of the order of buying in a bull market. And it can also tell you where you are in a bull market. So this is what the demand looks like, just for, to know what that demand looks like. We've got the demand here over time looking backwards. You can see that silver is in increasing demand, and more products that are being built are needing silver in it. So it's very robust from a demand standpoint. Now, what does the supply balance look like? Here's silver supply. I don't know if this chart is exactly right. I've seen different silver supply charts, but this one's saying that we are in deficits, every single year. Deficit. And someone would say, well, how the heck could you be in deficit the entire time? And what you're doing is you're just drawing down on inventory. So we're looking at inventory here. It's coming down. And at some point when inventory runs out, you're 100% limited to production. And if production can't meet the demand, prices start to go higher. Here is the global primary silver mine costs for 2019. If you notice, the silver price is at $16, means that these high cost producers over here are probably going to cut back supply, or they're going to start losing money. We've got the low cost producers down here. Let's say it's $7 or something like that. Here's 10 up here. So you can see some of the costs of producers and how it increases given your total production of silver supply. One thing to keep in mind is that usually these cheaper ones have been in production for quite a long time. They're going to be exhausted. They're going to start depleting. The new higher cost producers are going to replace the low cost producers over time, which means that over time you're going to have higher and higher costs to produce commodities, and that's really your bottom price increase, that as it stair steps higher between bubbles. So it'll bubble up, it'll come back down to where the higher cost producers are. This higher cost producer, they bring that supply offline when the price goes below it. They start cutting back, they start trimming costs. They cut back on looking for new discoveries. So this is kind of what you need to look for, because that's going to put a bottom for price. So a couple of observations just by looking at these things is silver was riding at a cost of producers for a long time. It was some years that it was riding in the $14, $15, $16, $17, $18 range, which was below the higher cost producers. Silver is being consumed at a faster rate than production, and we're drawing down that inventory. Producer costs are increasing, and it looks like they were getting close to $30 an ounce on that. And there's two main things I want to talk about there. Inflation increases production costs. Technology lowers production costs, which is deflationary. So you've got those two things kind of button up against each other. And then you've got new discoveries are lower ore grades, and they come online at much higher costs because you're going to have to move a lot more earth or material to get the minerals out of the ground. So here's a market balance. We've got rhodium here. And you can see, and remember what I said about market balance. We've got surpluses. So this is, if you notice, this is price here. Price went down when we have the surpluses. Then we have, this is a pretty large deficit. And you can see price skyrocketing higher. When surpluses came, it came back down. So if we're here and we see a little surplus, but we project that deficits are going to grow massively, I mean, what do you think this is going to do to the price? It's going to go way higher. So, even though we look at ratios and we do ratio investing between precious metals, and if you don't know what ratio investing is, you should check out my other clips on ratio investing. I don't know if even though rhodium could be expensive to the other metals in 2020, with this deficit looking like this, remember, this is a byproduct. It's only a million ounces per year of production, and they're projecting a 300,000 ounce deficit. I'd be a holder. I wouldn't sell yet. I would hold on. Don't worry about the ratio, because this deficit is looking massive. So there's another thing I want to cover. I call it, inflationary times. So all money is loaned into existence. On the front of a dollar bill, it says it's a note. All notes are debt. So money is debt, and money is loaned into existence. Inflation is 100% monetary. I don't care what anyone else says, it is 100% monetary. You inflate a money supply. You don't inflate prices. Prices go up because there's more money in the system. Prices are a symptom of inflation. Inflation, as you print more money and there's a greater supply in the economy, that means that prices will go higher. Doesn't mean that they're all going to go higher at the same rate. It means that some sectors could go way up, other things could go not up as much. That's another reason why we do ratio investing. We price things in terms of things to see relative value to get rid of that inflationary aspect. And also keep in mind that money is multiplied during the housing market booms as loans are expanded upon in our fractional reserve lending money system. Our fractional reserve lending system can increase the money supply up to supposedly 10 times, but some of these banks are getting, I think they're using more leverage than 10x. So keep that in mind, and I'm going to go through the housing cycle and housing market booms to show you that. So we've got 4 quadrants. We've got a recovery phase, expansion phase, a hypersupply phase, and a recession phase. No new construction. New construction's hitting hard in the expansion phase. At the top, you're going to look at your metrics. Inventory is going to be increasing and bulging. You're going to have high days on the market to sell. You're going to have a lot of new homes that are not selling and being built. You're going to see foreclosures, and eventually you're going to see lower prices. So we are nowhere near this. We are right like here. And I'm going to show you why I think we are just entering an expansion phase. So I'm going to go to housing starts next. And this is all important to understand. So we've got housing starts here. Let's just, I believe the demand is around 1.2 to 1.4 million homes per year. It's somewhere in here. So when you're above that, you're in an expansion phase. When you're below that, you're in a recovery or recession. So if you look, we had some massive moves over here. This kind of destroyed. So we went way higher. If you're at 1.4 here, we went way higher, and we're in this expansion phase over here, but it was a false expansion phase. We had a bunch of loans that shouldn't have been loaned out. This destroyed the home builders market, and you can see down here, it's never been this low. It destroyed it. They had to pull way back. We had a bunch of foreclosures, a whole bunch of problems here. This is going to be the largest bull market in housing probably coming up. And I don't think people understand that, and I'm going to show you. So this is a recession here, obviously, this down move. Massive down move, and it was down below 1.4 for a very long time, which means we are drastically underbuilt. We are 3.5 to 4 million homes underbuilt. That means that we have a deficit of homes. Any metric you look by, you're going to see inventory is low, days on the market is super short. You're going to see home prices going higher. Home prices do not move because interest rates are low. Home prices move because you have supply and demand imbalances. And if interest rates go higher, home prices are still going to go higher until that imbalance is satisfied, until we get back into a market balance, until inventory increases and days on the market becomes more normal. So this is the recovery phase right here. We still haven't hit an expansion phase, really. We just started getting into it, and then COVID hit. So we're getting into an expansion phase. This is going to take many years to get out of it, probably 5, 6, 7, 8, 9, 10 years. And we're going to see a housing market boom. Now, here's one thing to keep in mind. If you notice the recession here on all these down moves, you notice these recessions, these dark lines here? Notice how we have a recession every time this comes down. See that? Every single time. Recession, it's down. Recession, down. Recession, down. The housing market, when it goes down, remember the money supply. It's an expansion. We have a fractional reserve banking system. When this goes down, your money system isn't growing. It's contracting in some of these. And when it contracts, you get a recession. So all these recessions are almost always a result of a decrease of leverage or a contraction in the money supply. So you can use the housing starts almost as a precursor to a recession. And if you notice, they shut down the economy. We have this thing. So we had a huge collapse in money growth. We have a recession line coming in, and they're going to print like hell. So this is all, very important to understand. We've got high cost and low cost producers. I'm going to get into that here. I'm going to use a silver example. So we've got silver producers, and let's say the cost of silver is $15 an ounce. Low cost producers $10, high cost producers $14. Their profit's $5, the profit's $1, and let's just assume that they both have steady production. So you would think, well, this person's always going to make more money. But is that what we're interested in? And I'm going to show you something that it may not be. So if silver goes to 35 an ounce, the cost to produce is still $10. We get a profit of 25. Your old profit was 5, now it's 25. That's a 5x increase. Your high cost producer was 14 to produce, now it's $21. But it was at $1. So that's increase between 21 and 1 is 21x. This is your return because this is your increase in profit. 5x versus 21. This is why high cost producers in a rising, so we'll jump right to this. Earnings per share drive stock prices. Earnings per share is driven by profit growth. Profit growth grows faster if producers have higher operating costs in an increasing price environment. Now, there's got to be some risk. Where's the risk? Higher operating costs equals a higher likelihood of bankruptcy when prices decline, and that's your risk. Bottoms have the worst looking balance sheets. Tops have the best looking balance sheets in a commodity producer. It's always best to buy physical metals under mining costs of high producers. This almost always results in profits for smart money investors over time. You're just waiting for the price to come up as the supply gets cut back. After knowing all of this, we know that high cost producers will produce more profit in an increasing price environment because you're going to get a multiple on their profit. They're going to make hardly anything in the down market, and then they're going to make a whole bunch as prices go higher. I call this, welcome to being smart and finding the value, or being the smart money. Because if you know this stuff, you're going to know how big a bull market could be. You could be buying at bottoms when a lot of these companies are struggling. And then you're going to see it explode if you get a nice, good, increasing price environment where a lot of these companies are just going to explode in profit. Some of the largest bull markets are in commodities, not in like tech companies and stuff like that. Here's another thing. This is kind of an extension here. These are a whole bunch of different minerals. This is the declining ore grades over time. So the general trend, if you look at this, is just it's down lower. It means that minerals are getting harder and harder to extract out of the earth. You take the easiest ones with the highest grades, extract those first. Once those deplete, we go to lower and lower grades, which are more energy intensive and a lot more difficult to get out of the ground because you're going to have to move more material. And here's another thing. This is peak energy. This is the peak oil flow. So if you were to look at any one oil well, this is what it looks like. The world is just a collection of a bunch of oil wells or mining, whatever it may be. The one thing to note though, the gray one is energy to society to do work. This is oil minus energy to get oil. So this is net energy to society. This is your total volume of oil production. On the back half of oil production, you can notice that we're replacing very high return oil. Let's say you've got 100 barrels back for 1 barrel spent. We're going to less and less energy return over time. So we're going to 3-to-1 on like oil sands. So what this looks like is we could have a declining energy to society to do work, which means it's going to be a lot more difficult to get commodities out of the ground. even though the oil flow is delayed, a little bit behind it. But if this chart is right, this is 2020 right here. This means that we're on the decline. And I think that's why we're in such a mad rush to get electric vehicles and all these other alternative energies in the hands of more people. Maybe it's being masked under climate change. I don't know. But it's just something to keep in the back of your head. And this is also a very large push to physical precious metals because as it becomes harder and harder to get out of the ground, whatever's out of the ground and in your possession is going to become vastly more valuable. It also has monetary protection. If this does hit and energy is a little more scarce, so you have a lot less free energy in society, it means that the economies are going to struggle to grow. And if they struggle to grow and you have a debt-based money system, your money system will go. This is a copper. You can see 2020's right, here or so. And this is it. I mean, we only have another maybe 10, 11 years, and this is going to get harder and harder to extract as well for copper. So these are all bell curves, roughly. But I just wanted to show you that, keep it in the back of your mind. Maybe it drives you a little bit more to a portfolio with a little more physical precious metal in it. So a lot of information there. Watch it again if you want to. Get this kind of ingrained. We've got a commodity cycle that's coming up. I don't know if it's started yet. Maybe we're still bottoming out. Maybe it's going to be in a year or two. But it's good to know all of this information to position yourself for your portfolio. You might want some low-cost producers if the price is really depressed, because you know that they're going to stay in business. You might want a couple of high-cost producers. Maybe you want that leverage to the price move. That's what we mean by leverage, the leverage of their profit growth. But at a bottom, they can also go bankrupt. This is Finding Value. Hopefully this gets you a little more information about commodities. I'm going to continue to do clips. If you like these types of clips, please subscribe, comment on what you want to see. I'll do clips on what you guys want to see. I developed this channel for my viewers, not for myself. So let me know what you think. Let me know what you want to learn, and subscribe. Thank you.